What if I told you there's a retirement account that is better than a self-directed IRA in almost every way? Listen, if you're self-employed, the solo 401k is your secret weapon. Unlike an IRA, it lets you use mortgages to buy property without paying a cent in UDFI tax. It has 10 times higher contribution limits, and you can even take out a $50,000 personal loan from it whenever you want. Well, today I'm going to be breaking down why the solo 401k is the ultimate cheat code for real estate investors and how you can determine whether or not you qualify to ditch your old self-directed IRA for good. All right, let's get started. Okay, a solo 401k is a qualified retirement plan. And what that means is that in order to have one, you have to have a sponsoring business. And so if you currently have a business of which you're a sole proprietor, and the reason I say this, or I mean you're the only owner is really what I'm getting at, is because if you set up this tool and you attach it to your business, then you have to make sure that each of your employees also have the ability to participate in this 401k plan, and then you can't use a solo 401k. So this strategy is for those people who have their own business and they have no employees, or it's for individuals that don't yet have a business but can create a business such as a corporation, and now they qualify to have a solo 401k. So the way it works is as follows. We take a business. Now maybe you have an existing business already, as I talked about. Maybe you're a contractor, or possibly you're a real estate investor. You don't have an active business. You just have, LLCs. I see this a lot. People have LLCs set up for their real estate. But those LLCs would not qualify to do the strategy I'm about to share with you because none of these LLCs right here would meet an active trader business because it's passive. Real estate investing is passive. So all this stuff doesn't work. But what you could do if you want to use this strategy, create an active business to manage these assets. Now you have a business. So if you're watching this and you're a real estate investor and you're not a contractor and you don't have a side gig going on already, then create a side gig, set up a property management entity, set up your own corp. So as long as we can get an entity set up for you, it's an LLC, taxed as a corporation or a traditional corp, we're in business. Okay, so once we set this thing up here, we have our business here, then we will establish a solo 401k right here off of our business. So our business is referred to as the plan sponsor, okay? That means it's sponsoring that solo 401k plan. And the business owner right here, which happens to be me, or I can have my wife involved as well, we become participants in this plan over here. So we become participants in that solo 401k plan. So what does that mean to me as an individual if I'm a participant in that solo 401k? Well, assume this business that you've set up or you're running here is kicking off a lot of cash, right? Then any salary you pay yourselves, let's say that this person's making $100,000 in salary and she's pulling in $75,000 in salary, then depending on their age, they can be eligible to contribute up to $80,000 to their solo 401k plan. Now, not all of that's going to be deductible, but it's a way to super fund your 401k plan. And maybe you've heard about the trapdoor Roth is the way I've always referred to it. I mean, you can put in $72,000 this year into your 401k Roth account as an after-tax contribution by the employee, provided you're pulling out at least $72,000 in salary. So there's a lot on the funding side I'm not going to get into with this video because it's really driven towards the investing side. But having a solo 401k, we've been setting these things up since 2000, 99, 2000 was when we started our 401k department here at Anderson. And so we're very well versed in the nuances of using these types of plans for supercharging people's retirement. That 401k Roth strategy, that is phenomenal if you want a tax-free retirement. But anyways, I digress. So that's one way you can fund it. Now, a lot of people that start off, they hear this strategy, they are not using necessarily the funding from their business to put money in. What they're going to do is use a secondary funding source. And that secondary funding source is called a rollover IRA. So what is a rollover IRA? Maybe some of you who are watching me now, okay, you have existing self-directed IRAs. And if you watched the previous video in this series where I was talking about the prohibitive transactions and it got you a little nervous and that's why you're watching this video right now, that self-directed IRA, as long as it's not a Roth, it's going to be eligible to do what I'm about to show you. Now, if you don't have a self-directed IRA and you have a traditional IRA, we'll just call that standard IRA, it's going to be able to do what I'm about to share with you, provided that it's not a Roth. You'll notice something here. Roth IRAs are not eligible to do what I'm sharing with you. Maybe you have a 401k with a prior employer that's just been sitting there. That's going to be eligible for what we're about to do here. What am I getting at? Well, if you have any of these types of accounts, okay, after you set up your solo 401k, all of these are now eligible accounts to be used to fund your plan. That is, I can roll all of the assets from this account, or from this account, everything into this one plan now. Now, you might be asking yourself, why would I want to do that other than just the concern about the prohibited transaction rules, which still apply to this, but also the UDFI, the taxation of my IRA? Well, a lot of people have come to us to set up these types of plans because they want the benefits that come from a solo 401k, namely this, control, right? You'll know that when you have a self-directed IRA down here, that you work through an IRA custodian. With a solo 401k plan, you no longer have a custodian that you have to deal with. You're in control of your plan because you are the trustee of your plan. Okay, so when you set this up, your corporation is sponsoring the 401k plan, you're going to be listed here as the trustee. So you get this control over the plan. So that's a compelling reason why people do this, because when you're in control, you don't have to work through a third party to make investment decisions. If I see a piece of property that I want to buy, I can go negotiate that sale with my solo 401k plan. I can go to auction and buy property with my solo 401k plan. Because with my solo 401k plan that I have here, the way we set them up is we use Charles Schwab to get the accounts set up, and those accounts have check writing privileges. So our clients roll their IRAs into Charles Schwab under our 401k document, not Charles Schwab's. You can't do what I'm describing with their 401k. So they use our 401k document, and our 401k document allows them to make all manner of alternative investments. They're not subject just to equities, like Charles Schwab, for example. Their 401k limits you just to equities on their platform. But they get a checkbook, essentially. They can wire money out of the plan to make investments with the plan. So that control feature is huge. That's one of the reasons why people prefer to use this type of plan. Now, a second reason why you may be wondering you want to set this up other than what I described earlier is what I talked about in my opening, the ability to borrow. Okay? So with a IRA, self-directed IRA, doesn't matter, you can borrow all the money out, but you have to roll that money back into another IRA within 60 days, otherwise it's taxable. You see, with your solo 401k, it's a 401k plan, and you can borrow up to $50,000 and you have 50 months to repay, or 60 months, to repay. So rather than 60 days, we have 60 months to pay that money back to the plan, and you're paying interest back to yourself, of course, as well. So that's a compelling reason why people want to use this type of plan for investing. The third reason is you can pool accounts. Okay, now what do I mean by pool accounts? Well, I said that my wife and I, we're both going to be participants in this plan. So if I set up a corporation over here to manage our real estate, she's now an officer in that company, then together we're going to be participants in our solo 401k plan. So I can roll in my IRA, she can roll in her IRA, and now combined, let me just get rid of this stuff here. We may have now in this account, say $500,000 we were able to cobble together. So Now we can take those funds that were dispersed, maybe they were dispersed among 4 or 5 different IRAs. Now they're in one account. We can start leveraging that money and start investing with it. So that's a compelling reason why people like to use the solo 401k for investing. Now, the fourth reason why you want to consider this is that there is no UDFI. Now, in my prior video, I discussed the taxation of debt finance property inside of an IRA, and I went through an example in that video. In fact, there's a link right up here to that video. Okay, if you haven't seen it yet and you have a self-directed IRA, I suggest you watch that after this video to understand where the liability sits if you're investing in real estate and you're using debt. And you'll see how those taxes can start to climb on you, and your IRA's paying the federal income tax on money it's generating in what you thought was a tax-free or tax-deferred environment. Well, those UDFI problems with the IRA do not exist in the solo 401k. So if you want to use leverage in your investing, then the solo 401k plan is going to be the right choice for you for that leverage component. Now, the fifth reason why I like this is because you have forgiveness. What do I mean by forgiveness? In that prior video, I went through the example where someone engaged in a prohibited transaction, because under Section 4975 of the Internal Revenue Code, it lays out what a disqualified person is, and it talks about things that you can't do between a disqualified person and a self-directed IRA, or an IRA in general. It doesn't really carve out self-directed. But it also speaks to 401k plans. Okay, so those same rules, it speaks to retirement plans in general. So here's the difference though. If you screw up in an IRA, it's disqualified. And so if you watch that video, you'll see, I give you an example of what that means, where you possibly will lose up to 55% of your IRA to taxes if it gets paid out to you. Now, with a solo 401k, what they do is they impose an excise tax on the amount of the transaction until it's corrected. So if you engage in a prohibited transaction, you're going to pay a small excise tax on that amount to the IRS, but it does not disqualify your plan. It's basically a slap on the wrist and keep your assets protected. So to me, that is a very compelling reason why, if I am an active real estate investor, I want to be using a solo 401k plan, because you may make a mistake. You're not expected to know the entire Internal Revenue Code, right? Well, actually, you are expected to know it, but we don't know it. And so if a mistake's made and the IRS catches it, well, then your IRA is subject to being disqualified, which brings me to my last point: reduced audit risk. Now, the only 401k plan, or the only, let me rephrase that. We've set up thousands of 401k plans. Now, of the thousands and thousands of plans we've created, probably I can only remember a handful that have ever been audited. And it wasn't by the IRS, it was by the Department of Labor. And those audits were typically triggered based upon the investments, that the investments that were made inside of the plan were outside of the United States, and that's what generated the problem. So these plans do not get audited, and so that's another compelling reason why you should consider setting these things up. Okay, so if you're sitting there, you're with me this far, and you're like, yeah, I want to set these things up, well, let me just show you how you operate these. So in this video series, I discussed how to structure your IRA investing if you're investing into real estate. Now, the solo 401k is going to work the same way. So I could have taken that video. If I were to recut it for solo 401ks, I would do the exact same thing. So here's my solo 401k, and I have cash inside of here. And if I want to buy real estate, what I suggest you do is structure this with my level 3 strategy. And my level 3 strategy works as follows. You create a Wyoming LLC right here that's owned 100% by your solo 401k. You will be the manager of this LLC. So you're the manager of your LLC. Now, this will have a bank account up here, of course. Now, to buy your real estate, you set up LLCs for each of your individual investments. Each of these LLCs are owned by your Wyoming LLC as follows. Like this. Now, by structuring it in this manner, if anybody looks at this LLC right here, they will see the Wyoming LLC. They will never see the fact that the solo 401k is the ultimate owner of this limited liability company. The mistake that people make is they use what I call a level 2 strategy many times, and they don't include this Wyoming LLC. I've seen many solo 401k plans set up that have LLCs directly tied to the solo 401k. So if you go to the Secretary of State's website and you look up this LLC, you see it's owned by a retirement plan. So let me ask you this. If you're on the outside looking in and you see that an LLC is owned by a retirement plan, does that convey that, hey, maybe there's a lot of wealth there that we can go after? So let's push really hard. I think it does. And so from that standpoint, I don't want anybody to know that this property holding LLC is in any way tied to retirement plan, because I think that encourages lawsuits. I want to discourage lawsuits. And the way we do that is by using that anonymity shield of a Wyoming LLC right here. And it adds an additional layer of protection from anything happening here that may pierce this LLC right there. So that is the strategy for your investing with a self-directed IRA. You layer that with the other benefits that I talked about here, that we just showed you right over here. I think the choice is clear. If you're an active real estate investor, this is what you should be using for your investing in 2026. Hey guys, essentially there's only 2 reasons to choose a self-directed IRA for real estate. Number 1, that's if you have a business where you have W-2 employees. Because what I didn't share with you there when I was drawing this out is talking about one additional nuance. You can't go and set up another business and not have employees in there and set up a solo 401k if you have an existing business with employees, because the IRS will attribute both of those companies together, and that could really hurt you if you got caught doing that. So that doesn't apply to you. That's why you're going to use a self-directed IRA. The other reason why you would be using a self-directed IRA is if you just don't have a reason to create a business. I gave you the example of where someone could create a corporation to manage their real estate. I mean, the fact of the matter is, we've worked with thousands of people to create these plans, and we can find a way to create a business, all right, for you to set it up. But if you can't, then you're stuck and you're going to have to use a self-directed IRA and not the solo 401k. But hey, if you can create a business and you don't have employees, the solo 401k wins every single time, in my opinion, when it comes to control over your investing. I mean, think about it. In 2026, you can stash $72,000 away instead of just $7,500 if your business is paying out a lot of money. You can mortgage property with a 60% mortgage and pay 0 UDFI tax, as I talked about in my prior video. All right. So while the IRA owner is going to be writing a check for 37% of their leverage profits, you're not paying anything. And if you ever need cash in a personal emergency, you can write yourself a check for up to $50,000 or 50% of your balance from your 401k plan. All right. No self-directed IRA owner can do that unless they're willing to repay the money. That means liquidate their IRA and repay it within 60 days. All right. If you try to do a loan to yourself, it blows it up immediately. Okay. So listen, if you're a 1099 right now, or you have an LLC or an Inc., or hey, just set one up. As long as you don't have employees, the solo 401k isn't just an option. It's the only logical choice for scaling a real estate portfolio. Hey, to help you figure out if you're eligible to ditch the UDFI tax and start contributing $72,000 a year, I put together the 2026 Solo 401k upgrade roadmap. Listen, it includes the eligibility requirements, the new 2026 super catch-up numbers, and the exact process to roll over your clunky self-directed IRA into the high-performance solo 401k. Listen, I'm not putting the link in the description. Just comment the word solo below, and I'll reply with a link to the roadmap so you can see if you qualify to stop paying the IRS on your leverage deals and take advantage of the solo 401k. Take care.